What if I told you some wealthy investors treat crypto like digital real estate in Manhattan back in the 1980s? Sounds crazy, right? But here's the twist. The rich usually don't go all in on Bitcoin memes and random coins at 2 a.m. They build crypto portfolios the same way they build wealth everywhere else, with strategy, protection, and patience. So today, I'm breaking down the smart crypto portfolio tips high net worth investors use to grow wealth while avoiding the painful mistakes that destroy beginners. And trust me, one of these tips alone can save you from a portfolio disaster. Picture this. A successful business owner sells his company for $10 million. Now he wants exposure to cryptocurrency because everyone keeps talking about the next bull market. His first thought? Should I just buy Bitcoin and hope for the best? That's exactly where many wealthy investors go wrong. The ultra-wealthy don't think in terms of hype. They think in terms of risk-adjusted wealth preservation. Crypto for them is not gambling. It's one piece of a much bigger wealth machine. So let's walk through how they approach it. Never let crypto become the whole story. The first rule wealthy investors follow is simple. Crypto is part of the portfolio, not the entire portfolio. Imagine your wealth like a luxury hotel buffet. You don't fill the whole plate with dessert, right? Even if dessert is amazing. Dessert is crypto. Exciting? Yes. Potentially huge upside? Absolutely. But most high net worth investors keep crypto exposure somewhere between 2 and 10% of total investable assets, depending on risk tolerance. This keeps the upside alive without letting volatility destroy long-term wealth. The funny part? Beginners often do the exact opposite. They put 70% into crypto and 30% into stress. Wealthy investors reverse that. Build a core and satellite strategy. One of the smartest portfolio strategies is what professionals call the core and satellite model. Simple version? Your core holdings are the safer, more established crypto assets. Usually, Bitcoin, Ethereum. These are like the blue chip stocks of crypto. Then the satellite positions are smaller allocations to higher risk, higher reward areas, like Layer 1 projects, AI-related crypto tokens, tokenized real-world assets. Think of it like real estate. The mansion in the best neighborhood is your core. The risky land development deal outside the city, that's your satellite. If it wins, fantastic. If it fails, your foundation is still strong. Prioritize security like the ultra-wealthy. Now here's where rich investors act very differently. They obsess over custody and protection because making money is hard. Losing it to one hacked exchange password is tragic. Imagine growing a $2 million crypto position, then losing it because your password was Bitcoin 123. Painful. That's why wealthy investors often use cold wallets, multi-signature security, institutional custodians, estate planning access systems. They protect crypto like they protect family trusts. Because in crypto, security is portfolio performance. No security, no portfolio. Simple. Use rebalancing to lock in profits. Here's one of the most powerful strategies, rebalancing. Let's say crypto was 5% of your portfolio. Then Bitcoin doubles. Now crypto becomes 12%. A beginner says, great, let it ride forever. A sophisticated investor says, time to rebalance. That means trimming gains and moving profits into safer assets like dividend stocks, bonds, real estate funds, cash reserves. This creates a disciplined system of selling strength instead of chasing emotion. It's basically forcing yourself to buy low and sell high without overthinking. Wealthy investors love systems because systems remove panic. Tax strategy matters more than people think. This tip alone can save serious money. High net worth investors know after-tax returns matter more than headline returns. 100% gain sounds amazing until taxes quietly take a huge bite. That's why smart investors often use tax loss harvesting, jurisdiction-friendly structures, strategic holding periods, trusts or family offices, timing gains with lower income years. Here's a relatable example. Making profit without tax planning is like filling a bucket with a hole in the bottom. Money comes in fast but leaks out just as fast. Smart tax strategy helps keep more of what the portfolio earns. Don't chase every new coin. This is where humor meets painful truth. Every cycle, there's always a coin promising 100x gains, the future of finance, the next Bitcoin, a dog wearing sunglasses. We've all seen it. High net worth investors usually avoid emotional hype. Instead, they ask, what problem does this project solve? Who is building it? Is adoption growing? Is liquidity strong? Does it fit my risk allocation? They invest from a thesis, not a tweet. That one mindset shift separates wealth builders from gamblers. Let me give you a quick real-world style scenario. Two investors each allocate $500,000 into crypto. Investor A buys random trending tokens from social media. Investor B uses 70% Bitcoin and Ethereum, 20% selective growth sectors, 10% cash for opportunities, annual rebalancing, tax planning. 3 years later, both saw volatility, but Investor B kept more gains, slept better, and had a portfolio built to survive. That's how wealthy people think. They build for survival first, growth second, because survival is what allows compounding. So here are the big crypto portfolio lessons high net worth investors use. Keep crypto a smart percentage of total wealth. Use a core and satellite structure. Treat security like gold. Rebalance to lock in gains. Use tax strategy wisely. Ignore hype and invest with a thesis. The real secret? The wealthy don't try to predict every coin. They build systems that can win across cycles. That's the difference between temporary profits and generational wealth. If you enjoyed this breakdown, make sure to like the video and subscribe. See you in the next one.